With the caveat that we know you're not an expert on Middle East affairs, you are certainly not unfamiliar to how geopolitics affects the investor psyche and affects investment planning. When you have something like this that for a lot of people was a surprise, what is sort of the first thing that you look to in terms of telling your clients, your colleagues, your peers to do next?
Well, the important thing is to separate the noise from signals. And I think unfortunately, or perhaps fortunately, and I don't mean to sound dismissive, the markets have been conditioned in the last few years to react temporarily to these issues. They will bid up safe haven prices, gold, oil, treasury prices. But then as soon as they get the all clear signal that things are under control, they'll put it behind them and go back to whatever they were doing. So long we don't get further escalation in the coming days, I think the market will look past it. Now, one of these days, it will be proven wrong, because I do agree something has to get worked out in the long run, and the conflict seems to just be escalating.
I am curious about the cumulative effect of various sort of wars and other conflicts. Obviously, you have what's going on between Iran and Israel. Obviously, the Ukraine-Russia war continues to go on. You have other big geopolitical disruptions going on around the globe, not to mention a changing of the guard in terms of presidential elections around the globe that are really going to reshape foreign policy. This is much different right now, what we're seeing, than maybe what we've seen in past cycles here. How do you adjust?
I think you want to weigh the different issues. I think at least in the near term, I think the bigger catalyst is the U.S. election. If you have a Harris administration with a Republican-controlled Senate, that will be viewed as largely status quo. If you have a Trump victory, I actually think that's going to be very disruptive as far as the foreign policies, pertaining to the war in Ukraine, support for Israel, whether it gets, more assertive, and also the tariffs issues. So potentially the election can turn out to be more disruptive.
In terms of just the U.S. markets and how they respond to these exogenous events, I think about what happened with China, the week-long stimulus package that they announced, and how little impact it had on the U.S. market overall in terms of lifting sentiment and really inspiring people to go outside the U.S. And then you have the news today with Iran attacking Israel. And yes, there's certainly a movement in stocks and in oil, but if in the long term people are going to look past it, what is it about the U.S. market that has its participants looking inward as opposed to digesting the headlines from outside?
I think over the last 10 plus years, investors have been conditioned to overweight the U.S. So we tend to dismiss what happens overseas. In fact, you hear a lot of people saying that China is just uninvestable. And then last week, we get a sudden surprise with a pretty strong stimulus on the monetary side, and also the PBOC lending money to companies and investors to buy stocks. So you get a nice pop in the Asian market. So temporarily, that could mean outperformance by emerging markets. But again, the election could be disruptive because depending on the tariffs policies, right, that can again disrupt the emerging market rally.
How much are you seeing your clients ask you about the election? Because you point out all these different scenarios, but we might not get an answer until as late as January.
Most people are obviously interested, but we tend to have a very long-term view. So the strategic allocation has not been altered. In the meantime, tactically, you could play out a different scenario. So for example, if you have a blue sweep, I think the market will probably view it as somewhat negative for equities and positive for bonds. If you have a red sweep, that's potentially more inflationary, so it's negative to bonds, but then equities may do well on the belief of deregulation, potentially lower taxes. If you have a slick government, it's probably muted impact.
I am curious, though, we talk about some of the tailwinds for this market heading into this election. Interest rates finally coming down, an economy that's at least doing better than I think what people had anticipated here. No matter what the outcome of that November 5th election, is it possible that those tailwinds could outweigh any potential negatives we get from the election itself?
Right now, the thesis is synchronized global easing with the exception of Bank of Japan. I counted in September, we've had 25 rate cut announcements across the globe. So people will
Since September,
keep
25.
25 across the world. So that's the thesis. But then if you have a Trump victory potentially driving up inflation with new tariffs, potentially higher economic activities, would that then disrupt the rate easing, the interest rate cutting cycle that the market is pricing in? So I do think potentially there could be some risk to the Treasury market.
Are you concerned at all about some of the other risks that have been bubbling up? We have a port strike that just started today that could have significant economic consequences should it drag on for weeks rather than days. We have another strike over at Boeing that's still unresolved, as well as a lot of other issues that have the potential for an inflationary impact as well as an economic impact.
Yes, I do agree. These are really good points. Depending on how long they last, there is an impact on inflation, and that could potentially disrupt the market's complacency about the interest rate cutting cycle. And at some point, inflation could still make a comeback once everything settles down, especially with central banks being so aggressive on the easing side.
As much as you say that investors are conditioned to look past these headlines, these hiccups from overseas, are these latest headlines enough to at least derail or snuff out the bull market? I mean, are we done with making new record highs?
Well, given that we've done so well in the second half of September, so a little bit of pullback is normal. I don't think it's enough to really derail the bull market. So anything, maybe a 5% pullback, and then the focus in 2 weeks will be on the earnings season and then the elections.